Welcome to the Chapter 3 video lecture for Accounting 624. Chapter 3 is an interesting chapter. It's got some really broad overview parts, but it also has some really detailed parts. And so, sometimes we're going to fly at 30,000 feet, and then other times we're going to dive deep down to the Mariana Trench. So most of the deep dive is around the definition of dependents, filing status, because this is the chapter in which those items are covered. Those are very much individual items. If you've taken 503 or you intend to take 503, you'll probably see them again. However, the shift to the new core for tax includes all those items. And so at this point forward, the instructors, the faculty in the School of Accountancy decided that we really need to include that material. So if you're a BMAC student, for example, you probably didn't get that in 332, but going forward, you are going to have that in 332. So we're trying to match up with that new core element of the CPA exam. In any event, let's get going. So by now, you should all know the basic tax formula, tax equals rate times base. And what we're going to do in this chapter is talk about the expansion of the base computation. And as I like to say, we're really done with rates, right? Like the complexities that we suffered in that first chapter where I made us do capital gains, long-term capital gains calculations, and the increments on top of ordinary. And we've used the tables. That's kind of about as difficult as it gets. Really calculating the tax is the easy part. Where CPAs make their money is in helping taxpayers calculate the base. Okay. So how do we calculate the base for income tax, right? Well, we know it's taxable income, but how do we get there? Well, we kind of start with all income, and then we get to exclude certain things that the tax code allows us to exclude. For example, tax-exempt interest on municipal bonds is excludable under the tax code. The rules really say, hey, gross income is all income. Well, we'll talk about that in a little bit. In any event, an interesting quirk of the tax code is that gross income actually includes a deduction for the cost of goods sold. So normally all other deductions are dealt with separately and are a matter of legislative grace. But gross income in its definition includes a deduction for cost of goods sold. So what happens is then we take deductions for adjusted gross income. And adjusted gross income is just a subtotal. But these deductions that occur before it do so because the idea is you should get them regardless of what your income level is. Now, that's not entirely true. We'll see that some of these deductions for gross income are income dependent. But that AGI deduction, that's really there to help us for the deductions that are from AGI, many of which are dependent on your degree of AGI. So think of AGI as a barometer of income or wealth. And so when we say, oh, you can take this deduction, but only if you're poor, for example, oftentimes poor is based on some amount of AGI. So our deductions from AGI are either the greater of your standard deduction or itemized deductions. Man, what am I on? Slide 3 and I'm already yawning. I really need to get more sleep. So I apologize if I'm making yawning contagious on the video. Anyway, greater of standard deduction or itemized deductions. And then separately, you also get this qualified business income deduction. And we're going to cover all these parts later on in the course. I mean, that's what we're going to spend most of our time doing. So then you actually get to your taxable income, right? You multiply that by a rate and you get what we describe as tax before credits or pre-credit tax. Because the tax code is full of tax credits. A tax credit is a dollar for dollar reduction in tax liability. We'll cover those a little bit later in this particular video. And then you get to your net tax liability. You compare that, of course, to what you had withheld or paid in, and you either get a refund or you have an additional amount to pay. So the definition of gross income for tax purposes is super, super broad, right? Gross income means all income from whatever source derived. Wow, so you can't get any broader than that. But then the regs go in and provide examples. And they really say these examples are not all inclusive, right? They're just examples. So income realized in any form, whether in money, property, or services. So they don't have to pay you cash. They could pay you in stock. They could pay you in property like land, real property, or maybe personal property like machines or a motorcycle or a car, or they could provide services or chickens, right? So pretty much anything qualifies. Gross income means total sales less cost of goods sold, which I mentioned. And taxpayers generally recognize gross income when they receive the economic benefit. They realize that income. And then again, there's no tax provision that allows them to exclude or defer the income. Okay, so, when we think about economic benefit, we think about when someone loans you money, right? So do you have an economic benefit? Well, kind of technically, no, right? You have cash, but you also have an offsetting liability. Whereas when someone pays you your salary, you technically don't owe them anything back, right? That salary is yours to keep. Okay. Not sure why this slide is up again, but it is a beautiful slide. So often begs the question, why not look at it one more time? Oh, it's because we're going to focus now on deductions for adjusted gross income. Duh, you made the slide, Steve. You should know what's coming next. So I've highlighted some of the 4 AGI adjustments that are common. That's not to say these others aren't 4 AGI adjustments. They are. We just don't see them that often in practice necessarily. So the ones I've highlighted, deduction for a part of self-employment tax. So half of your self-employment tax is deductible. If you're self-employed and you have a retirement plan or qualified plan, you get a deduction for that. That's where that rolls through. Self-employed health insurance deduction also appears here. So these are all items where, to some extent, these deductions probably belong on the net profit of the business schedule, which for a sole proprietorship, for example, would be Schedule C. But for whatever reason, they pulled them off and said, no, we don't want these to be income-based. We're going to let you take them kind of regardless. And so they're out here in the 4 AGI adjustments. The other 2 big ones are individual retirement account deductions, so IRA deductions, and student loan interest deduction. And again, we'll talk about these others briefly, but they've over time, like not that many taxpayers use them, and the amounts aren't that big necessarily. Okay, so that takes us down to deductions from AGI. And this is in your table pack, so this is just a repeat of what you see. These are the amounts of the standard deduction. And you can see they vary by filing status, right? Married filing joint, surviving spouses, 25.9, heads of household, 19.4, singles, 12.950, and married filing separate, 12.950. So let me skip down to number 3 here at the bottom. If you're old or blind, they give you an additional amount on top of that standard deduction. So aged is 65 or older, and blind, there is a test for blind. You don't need to worry about exactly what that is, but it's worse than 20/20. In any event, the additional amount you get is, think of it like $1,750 if you're unmarried. If you're married filing joint or married filing separate, it's $1,400. So you basically get to add that in on top of whatever your standard deduction would have been otherwise. So that's the standard deduction. And think of it like kind of every U.S. taxpayer, every resident U.S. taxpayer gets to enjoy the standard deduction. The alternative is itemized deductions. Itemized deductions are reported on what's called Schedule A. And again, I've highlighted the major categories. So medical and dental expenses, if they're in excess of 7.5% of AGI. Taxes that you paid are deductible. Not all taxes, not income taxes, for example. These are largely state and local income taxes, property taxes, and a handful of other smaller ones. interest that you paid. And again, not all interest is deductible, only limited interest is deductible. Charitable contributions, so gifts to charity, these are deductible. And then casualty and theft losses. There's a handful of smaller other itemized deductions that sometimes a handful of taxpayers will get, but these boxes, I really highlight the big ones. And we're going to have a chapter where we unpack each one of these, right? So this is just kind of a general overview. Remember, sometimes I said we go at 30,000 feet. You're not required to understand the rules for medical and dental expenses or taxes or interest or any of these other things today, but you will be before we're done. Okay, so that would be your choice, right? And you get to take the greater of those two, the standard deduction amount or itemized deductions. And they really increased the standard deductions amount in 2018. Those are good through 2025, and then they actually expire and they go back to their smaller amounts. So what you find is many fewer people are itemizing right now. And I want to say about 90% of all taxpayers. It's called 87 might be the number. It depends on the year you look at, but it's been growing since 2018. Let's just call it 90%. About 90% of taxpayers take the standard deduction. And when you look at what you need for itemized deductions, you either have to have had a catastrophic casualty or theft, catastrophic medical or dental expenses, or you need to own a home, right? Because that's where you're going to pick up the taxes and the interest is through home ownership. Okay, the other from AGI deduction is the qualified business income deduction. And for now, all you need to understand is it's 20% of qualified business income. So you would measure your business income, right? And this is flow through business income. Again, I don't want to get too detailed, but this is income you'd report on Schedule E, or maybe income from a partnership or an S Corp that you report on Schedule E. And you get to take 20% of that as a deduction. So it's a totally fake deduction, right? It's got no ground in any reasonable deduction amount. It's just really a way of lowering the tax rate. So in this instance, the taxpayer has business income of $10,000. We'll assume it's all qualified. 20% of $10,000 gives them an additional $2,000 deduction. And you can see what it does is it serves to reduce their taxable income. And we will do much more of this later in the semester because I am seeing questions on this pop on the CPA exam. So I know they're paying attention. By the way, that expires also at the end of 2025. Okay, so we're rolling our way down this calculation. We're down to the point of taxable income, right? We just calculated that. What are the rates? So there are rate tables. These are the 2020 rate tables. Your table pack has the 2022 rate tables. But you'll see there's a single category, married, filing joint, or qualifying widower. I prefer the term surviving spouse. I'm seeing a slow migration over to that in the tax law language. But you'll see those terms used interchangeably, qualifying widower, surviving spouse. Married, filing, separate, and head of household. And we are going to get to the definitions of those filing status in this video. Again, your 2022 rates are in your table pack. I'm not going to present those here. So all those rate schedules, the ones we just looked at for now, for 2020, or if you have your table pack handy for 2022, those technically only apply if your income is above $100,000. If your taxable income is below $100,000, then technically you're required to use what are called the tax tables. And they publish these in the instructions to Form 1040 every year. And what they do is rather than you calculate the exact amount of tax, they calculate it for you. So if your income is between, say, $4,000 and $4,050 and you're single, your tax is $403. So that presumably saves the effort of having to calculate your tax if it's, you had $4,010 worth of income. They're just saving you that calculation. I actually think it creates more effort than it needs to these days since, again, well over 80% of us e-file our tax returns. Really the software does this calculation for you. And so maybe it's time to get rid of the tax tables, but that's not my call. They're still out there. We're not going to use the tax tables in class because that would mean I'd have to, print off 17 pages of tax tables for you to have all the time and on your exams, and it's not worth it. We're just going to use those tax rate schedules. But know that in real life, you would actually use these tax tables. All right, that brings us down to tax credits, and there are a number of them, and we're going to deal with those separately much later in the semester. But I do want you to understand the difference between a credit and a deduction. And again, if you're not new to tax, you've probably seen this before, but if you're new to tax, it's worth the explanation. So we've got deduction on the left, right? So let's say I'm comparing a $100 deduction versus a $100 credit. So on the left, I've got gross income of $1,000. My deduction serves to reduce my gross income, right? So that gives me taxable income of $900 times my 30% assumed tax rate. I have tax of $270. So you can see that what happens is that deduction is worth 100 times 30% or $30, right? That reduces my tax by $30. What would have been 1,000 times 30% is now only 900 times 30%. So I'm saving $30 worth of tax. So we think of that as the deduction times our marginal rate. A credit, on the other hand, is applied after the tax calculation. So I get no deduction. My gross income remains $1,000. Therefore, my taxable income is $1,000 times 30% gives me $300. But a credit is a dollar for dollar reduction of tax. And you can see that what happens is I reduce my tax to $200. So you get substantially more savings generally from the use of a credit than you do the use of a deduction. Okay, so let's talk about why this matters and why sometimes we see credits in tax code and sometimes we see deductions. Okay, so let's look at deductions 1 and 2. So it's the same deduction, right? It's the same scenario we just saw. Deduction 1 is identical. It's that $100 deduction at a 30% rate. Deduction 2 is the same $100, but in this case, the rate is much lower. So we've got a low income taxpayer, and you can see that that deduction only saves them $10, right? It doesn't save that. Oh, that should be $290, not $90. So here, let's go in and fix that while we're looking at the screen. So this really should be $290, and this should be $290. There we go. Oh, I like that so much better. Okay, so that really is $290. Why? Well, because no, it is not. I was right to begin with. Holy cow. Yeah, I could definitely cut this out of the video, but I like showing my warts and all, right? Even Professor Gill makes mistakes. Yeah, he makes them every day. So the tax is 10% of $90. So what does that deduction save? Well, it saves 100 times 10%. Well, that's only $10, right? So you can see the savings of $30 is greater. Why? Because it's rate dependent. So when we think about offering someone a credit for something like, say, having children, right? Let's say that we're going to work under the assumption that people who have children have a more expensive life. Then maybe we don't serve that up as a deduction because a higher income taxpayer is going to get a bigger benefit. Maybe we think the benefit ought to be equal regardless of your level of income. And so instead we say, oh, we're going to give you a $100 credit. Now, if you look at credits 1 and 2, you can see that even though the tax rate differs, the credit is the same. So the benefit you receive from a $100 credit is going to be the same regardless of what your tax rate is. And so this is why you see some times the policy invokes a credit as opposed to a deduction. Okay, again, we have a pay-as-you-go system. We'll worry about these deadlines in a future slide in this video. But generally, you have to file by April 15 if you're an individual. Same with corporations. Partnerships are generally due on March 15th, and this is just a reminder, and we know this now, right? Payment of taxes are not due on these same dates, right? You're actually required to make estimated payments because payments are generally withheld or paid during the year. And we'll really dig in on estimated payments. Again, we've already done it once last week. We'll do it some more. All right, so dependents potentially create an ability to pay difference, right? So, this idea of dependence is fraught throughout the tax code. And the idea is Marie and John are married, filing joint. They have no children. Pat and Carol are married, filing joint, and they have 4 children, and all of them are under the age of 13, and they also take care of Pat's mom. So the idea is, sorry, I just knocked a bug off my screen. That was weird. The idea is that Pat and Carol probably lead a more expensive life than Marie and John, and as a result, maybe we should adjust the way they're taxed, right? And this is under this broad scope of content that was in chapter 1 that we didn't really cover in the video, but is known as ability to pay, right? Taxes are largely based on your ability to pay. So what happens is various credits, such as the child tax credit, the child and dependent care credit, and the earned income tax credit, these all are tied to the number of dependents you have, or whether you have dependents at all. And so you can see that the tax code has these items in there in a way to make taxes lower for people who have dependents. There are 2 types of dependents, qualifying child and qualifying relative, and we're going to dig into both of these in pretty deep detail. But if there's ever one piece of tax trivia that's funny, and there's, by the way, no such thing as funny tax, but if there was, it would be that you don't have to be a child to be a qualifying child, and you don't have to be a relative to be a qualifying relative. But that is the way our tax code is written. So what tests apply to all dependents? So if you're trying to claim a dependent, what do you have to get past? What tests do you have to get past regardless? So you can have dependent, you can't. Wow, man, again, Steve is making lots of mistakes today. You can't have dependents if you can be claimed as a dependent by another taxpayer. Okay, so for example, if your parents claim you, you cannot have dependents. Dependent person can't be a married person who files a joint tax return. Okay, so let's say that you're trying to claim your kids and let's say your daughter, and your daughter's married. Okay, if they file a joint return, you cannot claim your daughter as a dependent. There is an exception to that rule, which is if the only reason they file a joint return is to claim a refund. And so what that means is, we'll see this when we talk about filing thresholds, that means they don't actually have enough income that they're required to file a return. They're just doing so because they want to claim a refund. So dependent must be a U.S. citizen, a U.S. resident alien, a U.S. national, or a resident of Canada or Mexico. So that's pretty interesting, right? You can be a resident of Canada or Mexico and actually be claimed as a dependent. Other countries, no such luck. Okay, so those rules apply to everyone. Okay, so if you meet all those, then you can say, all right, either I can be a qualifying child or a qualifying relative. You must apply the qualifying child test first, and we'll see why that's true when we look at the first qualifying relative test. So to be a qualifying child, the first test you got to pass is the relationship test. That means the child must be the taxpayer's or spouse, if they're married filing joint, son, daughter, stepchild, foster child, brother, sister, half-brother, half-sister, stepsister, stepbrother, or a descendant of any of those. Okay, so for example, your brother is not your child. That's why you can be a qualifying child and not actually be a child. Okay, so when we talk about descendant of any of them, that means your niece, your nephew, right? Those would be your brother's descendants. An adopted child is always treated as your own child, and it includes a child who was lawfully placed for you for legal adoption. So it's a little bit like, okay, the law has placed them with you, the adoption papers aren't quite signed yet, you can go ahead and claim the adopted child as a dependent. And we'll see when we get to the adoption credit, there's a pretty generous tax code provision for adopting children. So, there's ways to, make that financially viable as opposed to, birthing your own children. Okay, so here's the relationship test. So you're the taxpayer, and you can claim any of the people on this screen, right? So your sister, your brother, your half-sister, your half-brother, your son, your daughter, any of the descendants of any of those people. So if we work our way down, that means all descendants of any of these people. So if your son has children, you can claim them. If your niece has children, you can claim them. If your brother has children, you can claim them. If your brother's nephew or if your nephew has children, you can claim them. As long as they pass all the other tests. So that's the relationship test. Notice that it doesn't include, ancestors. So you can't claim your parents, for example, as a qualifying child. So you can't claim your brother's parent, which is arguably yours, but your half-brother's parent, right? No ancestors qualify. So as a result, we never work our way up the chain. We only work our way down the chain for a qualified child. Okay, the next test for a qualifying child is the age test. So the child, and we use that term euphemistically at this point, right? Because we know it doesn't technically have to be a child. So this person that we're treating as a child must be under the age of 19 at the end of the year and younger than the taxpayer or your spouse if you're filing jointly. So under age 19 means at age 19, you no longer pass this part of the age test, and that person must be younger. Okay, but there's an exception. Well, we'll let you be under the age of 24 if you're a full-time student. So in order to claim someone as a qualifying child who's 23, so I think of it at like ages 19 to 23, they have to be a full-time student. If they are permanently or totally disabled, you can claim them at any age, and that's for obvious reasons. So Bob's son is a graduate student in medical. He's 25. So the son fails the age test, okay, because his son, even though he's a full-time student, is not under the age of 24, right? So if Bob's son was 23, he could claim him as a dependent, but in this case, he cannot. This next example, if Bob's brother is 23 and a full-time student, if Bob is 22, then the brother fails the age test, because remember that to be a qualifying child, you must be younger than the taxpayer or the taxpayer's spouse. All right, the next test for qualifying child is the household, or sometimes called the abode test. And that means the child must have lived with the taxpayer for more than half the year. So that person needs to be living in your home for more than half the year. So they needed to live in your home for 183 days, right? That's what it boils down to. If they don't, they're not a qualifying child because they do not meet the household or the abode test. There are exceptions for temporary absences. For example, students may go to college and live in the dorms. That's considered a temporary absence. A child that was born or died during the year gets complete coverage for the days that they were alive. They consider that their year. Children of divorced or separated parents or parents who live apart, there are exceptions for them because it could be that they're splitting time between the two. We'll talk about the tiebreaker rules in a little bit. And kidnapped children, that's considered a temporary absence. Good to know, right? If your child is kidnapped. Thankfully, for the most part, we live in a world where there's not a lot of kidnapping in the United States. The next one is the support test, and this means the child must not have provided more than half of his or her own support for the year. So what this means is you may provide support for that child, but if they are providing more than half of their own support, you may not claim them as a qualifying child. So how do you compute support? Well, first you determine what amount did the child provide for themselves. So what did they spend on themselves? Then you determine as the taxpayer what was your total outlay for household costs, and then apply a fraction to that, right? And say, oh, well, this is one person out of X number of people in my household. So let's say I operate a household, and I say it cost me $10,000 for the year. And it's me, my spouse, and 2 children, one of which I'm trying to claim. Well, the total outlay for the house is $10,000. The part that I get to apply towards support for this child is 1/4 of that, right? Because there are 4 people in the household, so that would be $2,500. So as it stands right now, I'm spending $2,500, but that's not all. The next thing I do is I get to add direct support expenses to that result. So what did I pay directly for clothing for that person, education for that person, medical expenses for that person, and even travel and entertainment for that person? Those are all considered support. So I multiply the results of 3 by 50%, and I compare it to step 1 and decide, hey, did they provide more than 50% of their own support or not? Okay. So sometimes more than one person can claim a child as a qualifying child. So let's roll through some of those instances because there are rules. So if only one of them is a parent, the parent wins. So let's say one is a parent and one is a step parent, and they're both trying to claim the child. Maybe they're filing separate, or now they're divorced, or whatever it might be. If one of them is the parent wins. If both of them are parents, but they're not filing jointly. So let's imagine a situation where they're filing separately, or they're divorced parents, right? So they're both filing single, for example. The parent with which the child lived with more of the time wins. If they spent equal time in each home, then the highest adjusted gross income wins. If neither are parents, so you've got an uncle and a cousin, both who are taking care of this child, this person, neither of them are parents, and you just go off AGI, right? You just got to choose AGI. Now remember, you still got to pass that household or abode test. If a parent could claim but is not claiming, so in this case, the parent is opting not to claim the qualifying child, then the highest AGI rule applies, but only if the AGI exceeds the parent's AGI. So this is a way of preventing taxpayers from shifting that dependency around to lower income people. Okay, so they're not permitting that to happen. So Jennifer Rawls is an 18-year-old single mother who can be claimed as a dependent by her parents. Can she claim her infant son as a dependent on her own tax return? Can she claim her infant son as a dependent on her own tax return? Well, you need to walk through each one of those tests. Problem is, she's going to fail one of those tests, right? She is going to fail one of those tests. Let's go back and walk through each one. Okay. So is that child the taxpayer's child? Yeah, absolutely, right? This is her own son. So the relationship test is in good form. However, you can't have dependents if you can be claimed as a dependent by another taxpayer, right? So when we shoot all the way back down, that's going to kill this one all the way through. Let's get back. Jennifer Rawls is an 18-year-old single mother who can be claimed as a dependent by her parents. Boom, she's done. She's done. Okay. The next type of dependent is a qualifying relative. And remember, I said we apply the qualifying child first. Why? Because the first rule of qualifying relative is the person can't be a qualifying child or the qualifying child of any other taxpayer. Because if they're a qualifying child, there's a whole set of rules about who gets to choose if two people can claim that person. So if they're a qualifying child, boom, you're swept into those rules. You're never going to make it to qualifying relative. Okay, so let's get past that hurdle. A child isn't the qualifying child of any other taxpayer if the child's parent or any other person for whom the child is defined as a qualifying child isn't required to file an income tax return or files an income tax return only to get a refund of income tax withheld. Okay, so that's great, right? So you're not a qualifying child of another taxpayer if the only reason you're filing is to get an income tax refund, right? So cool, got it. Next, pass the relationship and household tests. Okay, you must either be related to you in one of the required ways, and we'll talk about what those are, or you must live with the taxpayer all year as a member of that household. Okay, so let's think about that. You either need to be related or you're unrelated. That's why you don't have to be a relative to be a qualifying relative, but you lived the entire year as a member of that household. Here's the magic relatives list. Son, daughter, stepchild, foster child, descendant of any of them, or brother, sister, half-brother, son or daughter, or any of them, or father, mother, or an ancestor or sibling of either of them. Okay, boom, that just expanded the list. Remember, qualifying child, we never looked above the taxpayer. Qualifying relative, we can now look above the taxpayer. Lastly, stepbrother, stepfather, stepmother, son-in-law, daughter-in-law, father-in-law. So here's the magic relatives list. And if you fit into any of these relatives, then you can be claimed as a qualifying relative. Or you can be unrelated and have lived with the taxpayer as a member of their household for the entire year. You also need to pass the gross income test. To be a qualifying relative, the gross income of that person must be less than some amount of money. And in 2022, that amount of money is $4,400. And for those that are old enough to remember exemptions, that's the 2022 exemption amount. Exemptions don't apply anymore, but they do because we use that amount for the gross income test. So they have to keep issuing what the gross income test amount is, which is the exemption amount. So gross income is income that is not tax exempt. So for example, you get to exclude non-taxable Social Security benefits and a non-taxable scholarship. So otherwise, you could get into a situation where you're trying to claim an adult who may be under the support test. If that taxable scholarship would be included, they might fail. Well, you don't have to include non-taxable scholarships. Or you're trying to claim a parent and they receive Social Security benefits, but they're fairly modest, so they're non-taxable. Boom, you get to exclude that from the gross income test as well. So the support test for a qualifying relative says that you as the taxpayer must provide more than 1/2 of the support for that person. And let's make sure we notice that that is different than the support test for a qualifying child. The qualifying child said the child must not provide more than 1/2 of their own. This one says you must provide more than 1/2 of the support for that person, because you can get in situations where you have 3 or 4 people providing support for an individual. Well, that's fine under the qualifying child test as long as they're not one of those people. On the other hand, for the qualifying relative, you need to be providing more than 1/2 of the support for that person. Okay, so there's our dependency tests. And we're going to use those to drive some of our filing status, but for some of them, that's not the case. So let's start with you're married. If you're married at year end, you are either married filing jointly or married filing separately. You don't have a choice, although you're going to see in a little bit there is an exception to that. If you're unmarried, you're either single, head of household, or you're a surviving spouse. Okay, so let's talk about what these mean. So in the table pack, how many different rate tables are there? Well, there are only 4, right? There are 4 of them only. Married filing jointly, because that includes surviving spouse. Married filing separate, single, and head of household. And we're going to see that head of household also includes abandoned spouse. Okay, so filing status changes both the tax table, changes your standard deduction. Remember, standard deductions differed depending on filing status. And it can also change a variety of other deductions and credits. So filing status is a critical decision to make for any individual taxpayer. So again, if you're married on the last day of year, you're considered married for the whole year, which means you're stuck with either married filing joint or married filing separately. If your spouse died during the tax year, you can continue to file married filing jointly with your deceased spouse. Because remember, that spouse may have had income during the year, they may have had deductions during the year, but because they died during the year, think of it as they give you this one last chance to file jointly, and they let you do so. Now, of course, if you get remarried, you might file jointly or separately, but with your new spouse, right? That means the old spouse is left out there, right? The old spouse is going to file as a single person, and you're remarried, so you're going to file in whatever category you want to, either married filing joint or married filing separate. Married filing separate, I like to describe it as restrictive from a tax perspective. There aren't many situations in which you are better off filing separately, but that's not to say there are none. They're generally worse because you have higher tax rates. If one of you itemizes, you have to both itemize. And you'll see that there are a number of credits and deductions that you're simply not eligible for. if you're married filing separately. Surviving spouse is different than when your spouse dies during the year. So let's assume your spouse died last year, right, in 2021. You can continue to claim married filing joint as a surviving spouse for 2 years after the date of death. Because remember, you can do married filing joint in the date of death regardless, right? But even if you remain single, you do not remarry, you can continue to claim married filing joint for 2 more years. So in our case, that would be 2022 and 2023, but only if you maintain a home that you pay over 1/2 of the cost of, and you're supporting a dependent child, right? That's not a qualifying child. That is actually a child. Okay, if you're unmarried, the most common filing status is single. This is the case where you have no dependents, or head of household. So this is a single with a qualifying person. And yeah, I know they couldn't just make the rules the same and say, oh, it's a single with a dependent. And the rules are very, very similar to having a dependent. But it's different enough that we call it a qualifying person. So the minor changes, right? So almost the same as a qualifying child or a qualifying relative. A qualifying child who is single can be a qualifying person, whether or not the child can be claimed as a dependent. A qualifying person can be a married child who is claimed as a dependent. It can be a dependent parent. And it can be a qualifying relative who lived with the taxpayer for more than half the year and is one of those magic relatives, right? Remember we talked about the magic relatives to be a qualifying relative, right? You got to be one of the magic relatives in order to be claimed as a qualifying relative and therefore a qualifying person to achieve. Remember, all this is about achieving head of household status. Okay. So there's also a classification called abandoned spouse. So this is technically you are married at year end, but your spouse has abandoned you. You can actually file as head of household, right? Which is considered a single filing. This assumes, of course, you're not filing jointly. You paid more than 50% to maintain a home. Your spouse did not live with you for the last 6 months of the year. And for over 6 months during the year, that home was the principal residence for a dependent child. You are an abandoned spouse, you can file as head of household. Okay, one last thing I need to mention about filing status is over the last 5 years, half a decade or so, the IRS has determined that, wow, taxpayers and tax preparers make a lot of mistakes on things over and over and over again. And one of them is classifying someone as head of household. And since that generally results in favorable status, and so there would be an inclination to push a single taxpayer into head of household if you could find a way for them to do it, they basically require you to do some due diligence as a tax preparer. And that requires you to complete a form 8867. And it's basically a due diligence checklist. And it says, did you ask all these questions and keep documentation? You don't have to file the documentation with the IRS. You do file the form that says you have the documentation, you asked the questions, and you documented the answers. And so that kind of raises your due diligence around this question so that you go through and you ask the right questions and you document those answers. And we have a very enjoyable in-class exercise on this if you decide to come to class next week. All right, Bonnie is single, and in 2022, she's got gross income of $12,000. She cannot be claimed as a dependent. Is she even required to file a tax return? So how do we figure out whether someone's required to file a tax return? Well, there is a way. So her gross income is $12,000, but remember, as a single person in 2022, she gets a standard deduction of $12,950. As a result, that's going to zero out her income. She's never going to owe any tax. And so is she required to file a tax return? The answer is no, she's not. If the standard the general rule is if the standard deduction zeroes out your gross income, you have no filing requirement. So if Bonnie was married filing joint, her gross income could go up to $25,900 because that's the standard deduction for married filing joint. It would wipe out all her income. And so as a result, she wouldn't need to do a married filing jointly, just like in this situation. She doesn't need to file as a single taxpayer. All right, so what you probably don't know is that on about my fourth or fifth yawn, when I'm recording my own video, that tells me it's probably time for me to take a little break. So that's what I did. I got up, got myself a nice tea, had a little beverage, activate the brain a little bit away from the videos. But now we're back. All right, and we're back to talk about the kiddie tax. So Elon Musk is mad wealthy. She's just uber rich, and she's in, as a result, the 37% tax bracket. She says, you know what? I have this 7-year-old child who has no income. So what I'm going to do is I'm going to give that child $1 million. I'll apply the unified credit, so there's no gift tax. And that child's going to invest these funds in a bond that pays 5% every year. So they're going to generate $50,000 worth of income. So, of course, if Ellen had kept that money for herself, the income would still be $50,000, but she'd pay taxes at 37% or $18,500. By shifting this down to her child, who has no other form of income, the $50,000 is going to be taxed at 10, 12, 22%, and end up as 6617, right? So a much lower tax rate. And that doesn't even presume, she doesn't wipe some of it out with her standard deduction or whatever. So you can see that just by shifting the income over to her child, she's going to save pretty extensive taxes. And, $1 million, why not $2 million? Why not $10 million? You can see there'd be no bounds on people. And of course, Congress hates this. This is called assignment of income. And it's a very popular tax planning technique, but not in this case because of something known as the kiddie tax. So the basics of the kiddie tax are that regardless of the rule, we're going to tax that kid's income at their parents' rate. And so who's subject to kiddie tax? Well, it's any child less than 18. And the kiddie tax is going to apply to unearned income that's above $2,300. And we'll talk about where that $2,300 comes from in a second. If you're exactly 18 and your earned income is less than 1/2 of your support, then it's kiddie tax on unearned income that's over $2,300. And if you're 19 to 23 and a full-time student, so that should sound familiar, right? That's just like the dependency rules for a qualifying child, right? You got to be a full-time student once you crest 18 years of age. And your earned income is less than 1/2 of your own support, then the kiddie tax is on your unearned income over $2,300. So you can see that no matter what the scenario is, they only capture you on unearned income over $2,300. So you can always shift a little bit of income to your kids. You just can't shift a lot of income to your kids. And you can see why. It's because it's going to be taxed at your rate after all. So how does this thing work? So the first thing is you go out and you have to measure what's called net unearned income. And net unearned income of the child is income that isn't earned, right? So that would be interest, dividends, rents, royalties, income like that, right? It's not wages, for example, or salary or self-employment income. If your child happened to have their own business, for example. So in any event, unearned income is usually, we think of it as interest and dividends. So the first thing you do is you deduct $1150. And that's just a magic number, right? They just give everyone a free pass for $1150, right? That happens to also be the same amount, and it is. They're adjusted at the same time every year by the same amount of the standard deduction that applies for a dependent. It just occurred to me in the video, we didn't cover that. So we're going to have to go back and cover that so you understand it, because that is reasonably complex. So it's the greater of $1150 or any itemized deductions, right? So if we're talking about a 7-year-old, they don't have any itemized deductions, or it would be really unlikely. So it's almost always that other $1150, but never say never. The one itemized deduction they could have is interest expense. And then it would be if you've really shifted a lot of portfolio over to them and they're actually borrowing money against their portfolio. you could end up in a situation where you had itemized deductions. And so the rule allows for that, but kind of what we're used to seeing in practice is that 1150. So you take that 2300 and you get rid of it. That leaves you net unearned income of 47.7, and that's going to be taxed at the parent's rate. Now, the remaining amount, that free 1150, that actually is still taxed. The standard deduction part is not, right? Everyone gets that standard deduction. But that 1150 is actually going to be taxed at the child's normal rate. So even though you reduce it and it's not taxed at the parent's rate, it doesn't mean that it goes untaxed. And so there's a pretty good chance that you're going to chuck in almost every time another $115 worth of tax. So the other thing parents can do is you can simply elect to include your child's income on the parent's tax return, right? You actually fill out a separate form and you just make their income your income. And you can only do this if all of their gross income is interest and dividends only. So the only thing they have is interest and dividends. And their gross income is between 1150 and 11.5. So the way the rule says is it's take that free amount, which this year is 1150, and multiply it by 10. And that's the cap on the amount that they can have. So it's 10 times that standard deduction amount for a dependent, which again in 2022 is 1150. And the child can't have had withholding or estimated payments because the IRS's payment system can't transfer that payment from one taxpayer to another, right? If it's associated with that child's social security number, they can't just be like, oh, just shift it over to the parents. So then you get into this mess where it's like, yeah, but we did pay. Well, no, you didn't pay. So basically the rule is, hey, they can't have made any payments at all against the tax. All right, so before we go for a walk in the park through all the forms, I do want to go back and cover the standard deduction when you can be claimed as a dependent, because it's a fairly complex calculation and it deserves our attention. And the fact that I didn't cover it then, shame on me. So let's go back and do that now. All right, I appreciate your patience. So we're back on the standard deduction page. And, I talked about aged and blind, and I just totally skipped over dependent, and I didn't mean to. And as it turns out, I didn't have any slides in the deck on it. So I've gone back and added some slides as well because, again, this is a confusing area, and many of you may be in this exact position. You may be being claimed as a dependent by your parents. Well, graduate students less so, but in any event, for a dependent in 2022, the standard deduction amount is generally speaking, it's cannot exceed the greater of $1,150. Remember that kitty tax number, or the sum of 400 plus their earned income. So in this case, it's wage income or self-employment income. Okay, so let's apply some examples to that, right? So again, the rule can't exceed the greater of 1150 or earned income plus 400. Both of those, so whichever one wins in the race between one or two, both of those are subject to the fact that it can't exceed the typical standard deduction for that filing status taxpayer. And I'll explain to you what that means when we do these next examples. Okay, so I popped the rule up there at the top, but Klondike can be claimed as a dependent. Done. And let's assume Klondike is a single taxpayer. Let's compute his standard deduction if he has no earned income. Okay, so if he has no earned income, it's the greater of 1150 or 400 plus the individual's earned income. So that's either 1150 or 400, because 400 plus 0 is 400. So his standard deduction is 1150. Part B, now he has earned income of 3,000. So now I'm comparing 1150 to 3,400, right? I get to add the 400 to his earned income. Well, 3,400, clearly the greater amount. So the standard deduction in that situation is 3,400. Now let's look at the last version. So it's the greater of 1150 or the sum of 400 plus earned income. And now earned income is 12,800. So clearly 12,800 plus 400, that's 13,200. That's way more than 1150. But remember, as a single taxpayer, he's subject to that limit as well. Whoops, sorry. So a single taxpayer's maximum standard deduction is 12,950. So what happens is in C, he's limited to $12,950, right? Because his earned income plus 400 exceeds that amount. It exceeds that amount. So basically, the most he could take would be the 12,950. Now, can that change? Yeah. What if Klondike were married? Because remember, you could be claimed as a dependent if you were married. If the only reason you file a tax return is to claim a refund. So in that situation, his standard deduction could be as high as 25,900. So, being claimed as a dependent gives you a pretty good opportunity to make earned income and still shelter that money. Now, more than 5 years ago, that wasn't the case. So that was a good change in the tax law to pick that up. Okay, so that takes care of standard deduction for dependents. And again, I apologize that we didn't cover that when we were talking about standard deduction. We're going to flip forward now back to where we were at the end of kiddie tax. See you soon. All right, so if you're familiar with the individual income tax form, you don't need to watch me do this, right? I'm just going to familiarize everyone with these forms, these top level forms, if you will. So if you're already familiar with them, you're not going to learn anything. But so think of it like the 1040, Form 1040, which is the individual income tax return for almost all taxpayers. There's a 1040 SR if you're 65 or older. There's a 1040 NR if you're a non-resident. But this is kind of the core of the U.S. income tax returns for individuals. It really is what I describe as an aggregator of information. And so you either report things directly on the 1040 or you accumulate things on to the 1040. So this top part, you can see here's the filing status question, right, that we talked about. So you got to select your filing status, and then you give, kind of your demographic information, name, last name. Taxes are based on Social Security numbers or taxpayer IDs. Notice that there's a question about digital assets. This is all about crypto. So these are this is a high point. Hot issue, if you will, for the IRS to be looking at crypto. So they're trying to remind you, if you have that, don't forget to look into it and report it because there's no natural reporting system in place yet. Then you're asked if you can be claimed as a dependent, because that changes everything, right? Because then they're going to look for a completely different standard deduction. Are you 65 or older? Are you blind? That's what's going on there for that extra standard deduction. And then you provide a list of your dependents, right? Their Social Security numbers. They're all required to have a taxpayer ID. What's their relationship? And we'll get to these eventually, but whether you're eligible for the child tax credit or the credit for other dependents. And notice that there's a big old draft stamp on these forms. We're looking at 2022s. They're not going to be released formally probably until either late December or January. But they do provide draft forms early. This one was probably cranked out in July or August. Okay, so now as we work our way through the 1040, you're going to see all these first lines pretty much 1 all the way down to 6C. These are what I describe as direct report lines, right? So you take your wages, you report them here. You take your interest, you report it here. Although there is a, as you can see over here, there's a Schedule B if required, and we'll talk about the requirements are, but it's if you have more than 1,500. Dividends, same, pensions, IRA distributions, Social Security benefits. You're collecting that information and you're reporting it for the most part directly right on the 1040. Now, lines 1B through 1I, these are actually all new this year. And I think what they're looking for is they're trying to highlight areas that they think possibly aren't being reported and should be. So household wages, right? So if you're a household employee, and that's, do you have a cleaning person that comes to your house? Are they claiming their wages? Are people claiming their tip income that wasn't reported to them on their W-2s? The Medicare waiver payments that aren't being reported on the W-2. They're fairly esoteric income items. And so it's interesting to see them appear on the face of the 1040. But like I said, it must be that the IRS is trying to highlight those items and try to capture them as forms of earned income. So not sure what, I mean, I can kind of guess the policy, but it's weird that they've decided to put those on. Normally, those are sequestered to a Schedule 1, which we'll get to eventually. Okay, anyway, then interest is reported, dividends, distributions, pensions, security benefits, and then you get down to capital gains. And this is where we first go to our first major, although arguably we did it up here with Schedule B, our first major supplemental schedule, right? So Schedule D is a form that captures capital gains and losses. I don't know if I can see it well enough to know which one of these is D. It might be this one. Yeah, it is. Good guess. So you can see what happens here is you report your short-term capital gains and losses, and down here your long-term capital gains and losses. And there's actually supplemental schedules for these. And so that's a form 8949. So you list the detail on 8949. It aggregates up to a Schedule D. You take the amounts from Schedule D, usually from page 2. And it says, hey, if it's a gain, take it up to line 16 of 1040. Well, that's kind of where we started, right? If we go down, we're actually on line 7. Geez, looks like they need to update the capital gain schedule. Looks like the draft is not in order because we're definitely not going. Oh, that's line 16 of Schedule D. We're going to line 7. So let's flip back to Schedule D really quick. Take another peek. Again, trying to make sure I guess the right one. Nope, guessed the wrong one that time. Which one is it? Oh, it's this one. Here we go. So here it is. You take it up to line 7. I just picked the wrong one. Sorry, my bad. Line 7 right here is where you're going to. And so you take that up and just report it there. Okay, so this is a supplemental, and it's feeding in to kind of mama form, and I think a mama form is being the 1040. Line 8 is other income from Schedule 1. Schedule 1 is another supplemental form, and it has a number of different items on it. So if ever there was a form that gets a lot of attention, it's probably Schedule 1. And again, we're using draft forms, you know that now. Okay, so here's part 1 of Schedule 1 is all the different forms of additional income. And those items that you saw earlier on the 1040, those other income items, I would have expected those to be packed in here in 8. But you can see they've really blown 8 out, if you're familiar with this, to tons and tons of lines. Okay, but what are the common ones? State refund, we'll get there. Alimony received, that's income, potentially. Here's where your business income rolls in off of Schedule C. That's another supplemental, right? So you do the whole net profit of your business, and then you drag it up from Schedule C to here. Rental real estate comes from Schedule E, another supplemental. Schedule F if you have a farm. So you're capturing other forms of income. And then again, here's a giant list of all these other types of income that you might have. And the form's constructed to kind of remind you, right? Oh, did I get, Olympic prize money that I need to report? I better put that down. And then lastly is your catch-all down here with 8Z. Other income, and you just list it out and put the amount in. Add them all up, add all these up, and boom, you take that total, and it's additional income that you're reflecting on your Schedule A, right? There's other income from Schedule 1, line 10. Add those up, that's your total income. Then we have our 4 AGI adjustments. Those are also coming from Schedule 1, and I'm hoping this is now Schedule 1, and it is. So here's part 2 of Schedule 1, adjustments to income. These are 4 AGI adjustments, and you can see they're all listed out. The common ones are kind of 1 through 23, and then the less common ones are broken out in 24, A through Z, where, it's just a bunch of stuff that might not, normally be on most people's tax returns. But they're all the same. Total it up. Drag that back, and we're back, of course, to Form 1040, right? That brings us to adjusted gross income. There's that hashtag subtotal. What's below adjusted gross income? Well, it's our from AGI deductions, which is standard or itemized, and it gives you the standard deduction amounts over there. There's the QBI deduction, and then you add those together, subtract them, and you get to taxable income. And that's kind of the way we calculate taxable income for an individual tax return. Next, you come to the taxes. Schedule 2 is additional taxes. I believe that's this one. No, there's Schedule E. Here's Schedule 2, right? Additional taxes. And again, it's just a supplemental schedule that's breaking them out. The big ones kind of are here in part 1, although self-employment tax is a big one too. And you add these up, ultimately 2 pages worth of all the other types of taxes you might have. They're non-income taxes. Add them up, boom, you're going to report them up on that form that we talked about, right? 1040 as additional taxes. We'll flip back over, see, from Schedule 2, line 3, and then down here, Schedule 2, line 21, the other additional taxes. You get credits. Those come from 8812. We're not going to worry about that for now. Then an amount from Schedule 3, line 8. So we got to determine what's on Schedule 3, right? That's additional credits and payments. So one of these we have discussed. That's the credit for excess FICA tax. At least I'm pretty sure that's on here somewhere. Let's see if I can find it. Blah, blah, blah. Maybe I'm wrong. Adoption, qualified vehicle. These are all these other various credits. I actually don't see it here. So maybe we pick it up on page 2. Premium tax credit, that's for healthcare, Obamacare. And here's the excess Social Security credit, right? Remember, we did an example of that in class where she overpaid that 0.9%. You're going to claim that back here, treat it as a payment. All those are going to go rocketing up to that Form 1040, and you're going to deduct those as kind of credits and payments against your tax. Here's your payments section. That includes, of course, what was withheld. It also includes any estimated payments you've made. Sorry, it doesn't highlight because of that draft watermark. It also includes refundable credits, right? Credits that you can get back in excess of what your actual tax is. And don't worry, we'll get to refundable credits eventually. Add all those up, you compare them, right? So 33 is more than 24, 24 being your total tax. Hey, you're overpaid and you get a refund. If it's the opposite, hey, guess what? The amount you owe. Okay. And then there's a line for estimated tax penalty. If you're prepared to do your own failure to pay and failure to file penalties, you can do those there. So that's the 1040. When we work our way through some of the supplementals, we talked about Schedule E being where you would record your rental, right? So here's if I have a rental condo or a house or whatever, I report all its information here, and the total gets dragged up to my 1040, right? So Schedule 1, line 5, and then boom, it goes from Schedule 1 on to the 1040. This is Schedule 3. We already talked about it. Here's Schedule 2. We already talked about it. This is Schedule D. We already talked about it. Schedule C, we said, is profit or loss from your sole proprietorship, your own little small business. And you can see it asks you to break out kind of your income and expenses. And ultimately, this is going to go up to Schedule 1, right? You're going to report that on the Schedule 1, which is eventually going to find its way to your 1040. All right, Schedule B is the one we kind of ignored. This is if you have interest and dividends that exceed $1,500. You have to report them, think of it as individually on Schedule B. So this would be all your sources of interest. Here's all your sources of dividends. And what happens is you add those up and you take them up to your 1040, right? 1040 line 2B for interest and 1040 line 3B for dividends. Schedule A is the itemized deductions. I discussed this earlier, right? There's medical, taxes, interest, etc. I won't make us look through that one again. This looks like Schedule 1, which I hadn't brought up before. Oh, it is, right? But we did discuss already. And let's see, did we look at all of them? Let me go to my little list here. We looked at 1, 2, 3. We looked at A. We looked at B. We looked at C. We looked at D. We looked at E. Yeah, those are the primaries. So almost all taxpayers are going to hit those, right? Most taxpayers only ever hit 1040. That's the only form they ever have to file. There used to actually be an easier version of it called 1040 EZ. It just had fewer lines. It said, look, chances are you really probably only have wages, a little bit of interest, and that's it. No other forms of income. And so we're going to make this form that's going to be really easy for you to use, and you're not going to get complexed and worried about, oh my God, do I have prizes and awards that are subject to tax? Most people don't. And so that form was out there. That form is in the dustbin. The Trump administration put that right in the dustbin. I guess they didn't want it anymore. So the easy is gone. All right, let's go back and finish out our slides. We're getting close to done here. Okay, so when to file. We already discussed that corporations and individuals file on April 15th. Everyone else is pretty much on March 15th, unless you're a corporation with a fiscal year end. We'll talk about that when we get to the corporate chapter. If the 15th is a weekend or holiday, you actually move forward to the next business day. So, for example, for 2022, the filing deadline would be April 15, 2023, but that is a Saturday. So you know we're already jumping forward to the 17th. However, April 16th is Emancipation Day in the District of Columbia. However, when Emancipation Day falls on Sunday, it is celebrated on Monday. So as a result, Monday is a holiday. On top of that, Maine and Massachusetts celebrate Patriots Day on that Monday. So what happens is, for individuals, our filing deadlines everywhere in the US for 2022 are actually going to be Tuesday, April 18th. We're going to get a couple extra days because of the weekend and the holidays. And this happens from time to time. It happened maybe 3 years ago as well. All right, switching gears totally, because the chapter does this and it does make sense. We need to talk vaguely, briefly about gains and losses. And we mentioned gains and losses when we brought up Schedule D, recall. That's where you generally report schedule losses, gains and losses, especially if they're capital gains and losses. Okay, so this is a brief introduction to property. That gross income includes gains, and it sometimes includes losses from the sale of property. And we now focus on this idea of realization versus recognition, because it's realization events that trigger gains and losses. So a realization event is a significant change in ownership rights. And typically we think about that as a sale, right? Most of the time we just categorize that under sale. There are other forms of realization events. We'll talk about those in a later chapter. Once you have that realization event, probably means you had a sale, exchange, or disposition. And it means you need to determine what is the amount realized, what is your adjusted basis in that item. Those are tax terms. That drives your realized gain or loss. You might defer or exempt that gain or loss. And then whatever's left, you actually recognize. So realization generally results in recognition and is basically a precondition to recognition. You generally do not recognize a gain or loss that you haven't realized. As with everything, there are exceptions, but they're fairly esoteric. Things like straddles, there's some options when you get involved in hedging. You might actually recognize income before you realize it. Okay, so what is amount realized? I said that was a magic term. You can deconstruct it as what did you get? Right? So you got cash, someone paid you cash, that's pretty common. Maybe they gave you property, maybe they gave you chickens. Maybe they took away part of your liabilities, right? That's part of your amount realized, and then you reduce it for any selling expenses you incurred to sell that item. That's your amount realized. What is the fair market value property? According to the tax code, that's the price at which property would change hands between a willing buyer and a willing seller when neither are under any compulsion to buy or sell. In an exchange, and we'll talk about exchanges later on, much later on, the general presumption is that the fair market value of two items exchanged is equal. So if Bill trades land to Susie for stock worth $30,000, stock often has a readily determined value, right? Oh, it was traded on the New York Stock Exchange. We can determine exactly what its worth was on the date of the exchange. So with that, generally what we would do is just assume that the land has the same value, right? Because the land, we really don't know what it is, and we can have an appraiser come in and do all sorts of things, but it's not like there's a market, a liquid market for land like there is for stocks. What is adjusted basis? That's generally the cost of the item, less any cost recovery. Cost recovery in tax terms is generally depreciation, amortization, or depletion, but we'll get to more on basis, eventually, not this lecture, because this is just an overview. So again, most gains that are realized are recognized. Some losses that are realized are also recognized. So the tax code is asymmetrical with respect to gains and losses. You almost always have to pay tax on gains, but you don't always get to reduce your income for losses. What are the exceptions? So sale of personal use property. So let's say I sell my house or my car. That's personal use property. I generally have to realize and recognize the gain on that sale, but those losses are realized, but they are not recognized. They are not recognized. You are disallowed a loss on personal use property. Like-kind exchanges, the gain and loss is not recognized. It tends to be deferred over time. And as I said, we'll get to those. And a wash sale. And again, a wash sale is something you have no idea what it is yet unless you remember it from previous tax class. Wash sales generally aren't recognized either. They're deferred to a later date. So when we think about gains and losses, one of the things that's really important is character. And we really haven't unpacked character in its entirety. We're going to do that this chapter and a little more next chapter. But there are some common characters of income. And one of them we did deal with on our first day, and that was those capital gains. Remember when we talked about how capital gains were taxed at a different rate if they're long term? So that is one of the different characters of income. So there's ordinary income. We think of that as largely wages and self-employment income. There's capital income, and we'll talk about that more in a second. And there's tax-exempt income, right? So that's income that's just not subject to tax. That's our favorite character because we don't have to pay any tax on it. So long-term capital gains, we know, enjoy preferential treatment, right? They have a lower tax rate. It can be as low as 0 on long-term capital gains. Capital gains are also subject to netting rules. Now, we'll get into those netting rules in brevity today. There'll be a much deeper dive later. But what it means is that we got to know what transactions are capital gains and losses versus other gains and losses because they're subject to special rules. So the general rule is that all gains and losses are ordinary, right? And therefore, they just become part of your ordinary income. However, capital gains and losses are generally derived from the sale of what's called capital assets. There are exceptions, right? And we will cover each one of these exceptions eventually when we get to that chapter. But for now, we don't have to worry about them. We'll just worry about the sale of capital assets. What is a capital asset? Well, it's defined by exception. The tax code says that a capital asset is everything that's not a capital asset, okay? And definition of capital asset can depend on the use by the taxpayer. And we should recognize that both individuals and corporate taxpayers generally prefer capital gains to ordinary income. For individuals, it's because they're taxed at a lower rate. And for corporate taxpayers, it's because you can't offset capital losses with anything but capital gains. So we'll walk through that in a little bit when we do netting. So what is not a capital asset? Section 1221 of the Internal Revenue Code lists out all these items. And of all of them, like inventory isn't a capital asset. That's going to generate ordinary business income. Go down to number 4, accounts and notes receivable acquired in the ordinary course of business, right? So if I sell inventory and I get an account receivable for it, when I collect that account receivable, that's also not a capital asset, right? That is an ordinary asset. And if I factor, for those of you that remember factoring receivables from your accounting days, if I factor my receivables, that I don't get to treat that as a capital gain. Trade or business property, the sale or exchange of trade or business property, right, does not result in capital gains or losses. That's the other big one. Patents, inventions, models, designs, not capital assets. And then we start to dig pretty deep into things that you probably aren't going to see very often. And so this can be treated differently depending on how the taxpayer uses it. So if Jimmy owns a car for personal use, that's a capital asset, believe it or not, right? He may not be able to deduct the loss, but that is a capital asset. It's not on the not a capital asset list. If Jimmy owns a car dealership that owns a car, well, now that's inventory, and that makes that not a capital asset. And if Jimmy operates a business in which he uses a delivery car, well, that's property used in a trade or business, and that is not a capital asset, right? So inventory, trade or business property, numbers 1 and 2 on the not a capital asset list. So even though the asset is a car, its use generates a different character. Okay, so why is holding period important, right? Holding period is what you describe as the length of time between that you purchase something and you sale, exchange, or dispose of that item. That's your holding period. And ordinary rates are 37%. We know capital gain rates are 15, but they could be as low as 0 or maybe as high as 20. Short-term capital gain rates are the same as ordinary rates. So in order to get long-term capital gain treatment, we have to have held that item for more than 12 months, more than 1 year, right? We have to hold it for greater than 1 year. So when we're measuring the dates we've held it, that excludes the date of acquisition, but it does include the date of sale. It's based on calendar months, not on 365 days. So it's a little bit like the April 15 and the extension rules and counting the penalty, right? So if I buy it on January 1st, first off, I don't get to include the acquisition date, right? But it's not going to achieve long-term status unless I sell it on January 2nd of the following year, because it's based on calendar months. So, February and leap year can create problems around things like that. It's based on the trade date for stocks and securities, not the settlement date, if you're into, trading stocks. All right, so basic netting. We're going to do more complex netting later, but not in this video. Capital gains and losses must be netted against each other, and you net when signs are opposite. So the first step is you net all the short-term gains and losses with all the other short-term gains and losses, and you get a net short-term gain or loss. Then you take all the long-term gains and losses and net those together, and you'd end up with either a net long-term gain or loss. Now you look at them and decide what you're going to do. Well, if they're both gains, then short-term is swept into ordinary income and long-term is reported, and you do that crazy tax calculation that we talked about. If they're both losses, we'll see what happens there in a second. If you have a net gain, it's either a net short-term gain or a long-term gain, right? So one of those is going to absorb the other. If it's a net loss, it's either a short-term or a long-term net loss. One is bigger than the other, and it's going to absorb them. And that would mean that short-term and long-term have different signs, those last two. So if they're both gains, short-term ordinary, long-term preferential rates. If they're both losses, capital losses are limited to $3,000 per tax return. So that means if you file as single, you get $3,000. If you file married filing joint, you get $3,000. That's the most you can deduct against your ordinary income is $3,000. Then you use up short term. If there's any more left over, then you could take long-term losses. Anything you don't use, you carry forward into future years when you hopefully generate capital gains that you can offset. And the carryover keeps its character for individuals. So if I have short-term above 3,000, that short-term carries over. If I have long-term above and beyond that, then it carries over as long-term as well. If it's a net short-term gain, you just treat it as ordinary, right? So that would be a situation where I have a short-term gain of 4,000 and a long-term loss of 1,000. Well, that results in a net short-term gain of 3,000, taxed as ordinary. If it's a net long-term gain, let's reverse the numbers. Now I've got a long-term gain of 4,000 and a short-term loss of 1,000. That nets together to a long-term capital gain that I would enjoy preferential rates on. If it's a net short-term or long-term loss, use the 3,000 and you carry forward the rest. Okay, for corporate taxpayers, and again, we'll unpack this later, but it's good to know the differences now. You net short-term and long-term as we did before. Net gains are not taxed at preferential rates for corporations. Gains are just taxed at 21%. Net losses are totally not deductible, right? So a corporation doesn't get a $3,000 free, it gets none free. So to the extent you end up with a net loss, short-term or long-term, doesn't matter. You can, however, carry it back 3 years against maybe net capital gains you had in the previous 3 years, or then forward 5. And we'll do some really great in-class exercises on those. All right, the last topic, and then we're done with this video. I'm sure you guys are going to be super happy, is virtual currency, right? So this is your classic Bitcoin. Under IRS current rules, Bitcoin is treated as property. Therefore, it has basis and amount realized when you sell it. So like when you exchange money for something, you don't sell money. You're just giving the money and you're getting something. That's not true with Bitcoin. This is like paying with property. When you sell property, you generate a gain or a loss. That's how you treat virtual currency. So Mike sells some illegal property and he's paid 0.005 units of Bitcoin, which is worth $100 on the date of the sale, right? So what does Mike have? He's got 0.005 units of Bitcoin now. He sold the property. He might have a gain or loss on that illegal property, but as it stands right now, nothing on the virtual currency. In 8 months, he uses his virtual currency and he's like, oh, I need to buy some stuff. Maybe it's more illegal stuff, doesn't really matter. But he buys some stuff and he uses his 0.005 of Bitcoin. Well, again, normally when you acquire something, you just acquire it, right? And there's no tax result from that. But in this case, it's as if he sold the Bitcoin for cash, then turns around and spends the cash. Well, when he sells the Bitcoin, he got $103 for it because that's what it was worth on that date. His basis in the Bitcoin was 100. He's going to recognize a $3 short-term capital gain, right? If he'd held it for more than 8 months, if he'd held it for more than a year, he'd have a long-term capital gain, but he'd still have a capital gain. That doesn't happen with money, right? If someone pays me $100, that's income, no question, right? But then if 5 years from now I spend it and I spend it for $100 worth of something, there's no gain or loss on that. It's just still $100. And it doesn't matter if the value of that currency has gone up or down. And that does bring us to the end. I look forward to working through in-class exercises with you guys if you choose to show. If not, remember, 7 p.m. we have a quiz. Thanks for watching.